All right, folks, welcome back. Just a quick little review on post-analysis. Yesterday evening, I gave you a breakdown and review of E-mini S&P, and I told you what we would expect to see going into Thursday and Friday. And this is the chart that I showed you last night. Don't take my word for it. Look at the previous recording. I can't edit it. It's already uploaded on YouTube. It's time and date stamped. This is the levels here. I mentioned how we would draw above for the buy side here and draw into this old weekly imbalance. This is what we saw today. This is a weekly candlestick, so we can see the weekly chart did in fact expand in the direction I was expecting. We did get the buy side above the high here, and we did trade inside this volume imbalance. For the folks that are asking and mentioning and kind of like talking amongst themselves in Twitter, why am I not using the continuous contract on TradingView? Well, the continuous contract is not going to show you the inefficiencies that the actual individual delivery contract months will. For instance, if we get above this high here, I like this SIBI and I also like this volume imbalance. So it depends on how much continuation we have in price action, but we take one step at a time. So the benefit of having a thinly traded contract, because this contract was trading well before it became the front month. Right now we're trading the June contract. Well, this is the June contract shown in a weekly chart. If I show a continuous chart and then compress it into a weekly candlestick chart, the inefficiencies won't be so obvious. So this is one of the built-in advantages of having a time-based chart. There's a lot of people out there that will claim that time-based charts are useless and you have to have some other form of analysis or some kind of other bar or something to that effect. That's nonsense. You have no idea what you're talking about when you say that. Time-based charts is exactly the root of why price is going to go where it's going to go, because the algorithm runs on time first. It's time and price theory. All right, and here is the daily chart I showed yesterday evening. So here's yesterday's chart. All I did was use the same slide that I created yesterday evening, and now here's what we're going to see today. There's the delivery to the buy side I told you we would see, and we drew into that weekly volume imbalance. Not hard, is it? Not complicated. I'm not trying to bring in every ICT concept I've ever created into one single model. I'm looking for a simple idea. Where's it going to draw to next? I outlined it. I showed you why. I built it from a weekly chart to a daily chart to an hourly chart to a 15-minute chart to a 5-minute chart and a 1-minute chart. I can't make it any easier than this, okay? All you're looking for initially while you're trying to learn under my wing, you're looking for the skill set of knowing where price is going to draw to next. Okay, it's going to go higher, it's going to go lower. I am lending you my experience as a mentor so that way you can study price action with that in mind. It's not that we're trying to create challenges for you to never succeed at. I'm telling you this is where the bulk of your work should lie in the beginning. It's not looking for entry patterns. It's not looking for the new ICT gadget or concept. You want to be focusing on journaling, going back through old data, and finding these repeating phenomena that I'm teaching you, because once you see it, you can't unsee it. Once you learn it, it can't be unlearned. Then you'll be initiated. That's the cult of winning we have around here. Okay, everybody likes to say we're a cult, and I've gladly accepted that, and we're the cult of winning. You can see here again, no hindsight. Okay, I can't manipulate daily and weekly candlesticks when I told you beforehand what to expect, and here we have it. So let's take a closer look at what we saw this week. So here's the price action as I mentioned last night. Only thing I did take off the gradients in here, and these little arrows, don't be fooled by that. Okay, all I'm showing you is the key turning points. So when you're doing your journaling and you're logging all of your price data and looking at old moves, you want to be putting arrows there because it trains your eye to see it just like that. And then when you start practicing your executions in the future, not now, you'll see that you'll be entering at these types of levels and with a logic behind it. So last night I took you to this fair value gap here. I said we would draw up into that, and then the buy side and the weekly volume imbalance, so that shaded white area up here. Okay. I also mentioned to go back and watch that video I said while we were consolidating here, we would likely, because we didn't do this run up here yet, this was all midnight. We were trading in this little area here. I said we would likely draw down into this buy side imbalance, then go higher. We did that very thing here. If it drops just inside of that imbalance, and we're expecting a shallow drop, that run is going to be initialized by a institutional order flow entry drill. And that's a tongue twister. That's why I labeled it an IOFED, just an abbreviation of institutional order flow entry drill. It's a partial entry to a fair value gap, whether it be a buy side imbalance, sell side inefficiency, or a sell side imbalance, buy side inefficiency. So either or, and since we have an up close candle here, that makes this a BISI, buy side imbalance, sell side inefficiency. All of the things I just mentioned are by category of a PD array is a fair value gap. But a fair value gap can be broken down into different classifications. This being a buy side imbalance, sell side inefficiency because it's going higher, it's offered buy side. It's imbalanced because it only offers buy side. It's one single candle doing it, so it's inefficient in the sense that it's not offered any sell side. But if the market's bullish, as I've been indicating to you that it is, it's going to go down into this area here and keep some of that open. So we did that very thing here. We dropped down into that candle's low just a little bit and then rallied up, created another buy side imbalance, sell side inefficiency with this candle here. This candle's high, that candle's low, frames this as a buy side imbalance, sell side inefficiency. We also have a breaker here. So the market trades down into that. Also, consequent encroachment of this gap. This is a daily fair value gap. This was the daily discount fair value gap. Remember the two areas here on the daily chart. Go back and watch last night's video. You'll get better insights by doing that all over again. And I promise you it's not a long video. You're welcome to speed it up at 2 times the speed. But the price goes down into consequent encroachment, which is the classic optimal trade entry that I've taught many years on this channel. But it's coming back in to touch and reprice this candle's high. So once it hits that, then it's permitted to leave that range. Once it trades above this high, this becomes a balanced price range. So we can trust that it's going to go higher. Higher where? To the buy side here, and then dig into that weekly volume imbalance, which is what we see it did here. Dropping down into a 15-minute candlestick chart, you can see that we had that institutional order flow entry drill. It drops down here during the morning session. This is a Judas swing. It rallies up. What is a Judas swing? It's a fake move. Okay, so it rallies up, creates a 3-drive pattern. I did 2 trades in here. I shared that on Twitter just because people ask all the time, did you do anything? So I did. And then the market went down, dropped into a fair value gap here, and then rallied up. And then I chose to engage the afternoon session, which was a silver bullet trade for the PM session. And let's take a closer look at that morning session first. So we have the 3 drives pattern here. 1, 2, 3. Institutional order flow entry drill down here after taking sell side out. It rallies. Then we have the short-term reversal pattern here. This is a classic price action pattern. It's really good to indicate that we're likely to see some measure of retracement. It can be an all-out reversal, but because we have unfinished business, which is that weekly imbalance up here, that weekly volume imbalance specifically, NASDAQ has done outstandingly on the upside. As I mentioned, I've been coaching you along with NASDAQ being the leader at the upside, and it would draw ES up higher in sympathy. So this is a 6 sister concept. I'm trading the pair that has lagged. Okay, I did trade in NASDAQ today also. You can take a look at that on Twitter. I showed the examples and executions there. But I wanted to teach you using the 6 sister concept because I kind of the flavor of the month, ICT flavor of the month concept, using this idea that it will want to catch up to what the NASDAQ has done. And we see that here really moving to an upside run into that weekly volume imbalance with an extrapolation that was just really, really nice to be a part of this afternoon. We have a breaker here. So we have high, low, higher, high, extend that through. That's this little retracement here. It broke down just to clear out the sell side here. Then we entered into the New York PM session, which is 2 o'clock to 4. And then we had some fair value gaps and such. And then the final hour of market on close macro that I've been teaching vaguely, which will be taught in great detail in my books that are coming out. And everyone that keeps asking on Twitter, when is my first book going to be released? I set a challenge for all of you as a community. Once I got to 1 million subscribers on YouTube, I would release book 1 of 4. 3 of the books are technical in their algorithmic theory, my concepts. And then the 4th one is a fiction. Okay, it's not essential reading, but it is what it is, right? So I have other things I'll teach you throughout the year. Some things I'm going to hold off for the book because there's a lot of people out there taking my concepts and hurry up and rushing them into their own little books, and they're incomplete. And I'm offended by that because you're trying to get something out ahead of me when you have it incomplete. And that's why I'm holding it back, because once I put it in print, then it's going to be hard for you to run around and pretend you created it or found it on your own. So here we have a closer look on the 1-minute chart. Imbalance refined into that fair value gap here. It drops down in, clearing up relative equal lows here. Before we get to that, let's look at the 3 drives pattern. We have consequent encroachment of this imbalance. Runs above this short-term high. You watch me do a execution on partials here. I took a long on a fair value gap, took partials here, rolled the stop to better than break even, came back, hit my stop, and then once more I went back in and went long once more above the highs. I took partials, rolled my stop to better than break even, and it came down and stopped me one more time. I was trying to position myself because I was going to be away from the charts throughout the afternoon. I was with my wife and driving in a car and riding in a car, and I can't be in front of my desk. So I'm looking at everything through my phone only, which is something you don't want to do. But for practice sake and giving you all examples on Twitter to follow along, that's the best I could do today. The market broke down. We had the breaker here. Really nice run to that breaker and fair value gap right there. That right there, this folks, right here, this thing right here, that is a complete model. We have a higher structured, not that it's higher time frame, but a higher structured breaker. Okay, a breaker is a low that has a high to the left of it and a higher high to the right of it. Okay, so it's high, low, higher high. Once this low is broken, it is here. We have an imbalance. That little imbalance right there, that fair value gap that's not highlighted, it's trading up into that and then hitting the breaker. This is also an optimal trade entry. It's also trading into a what? Bear shorter block, which is a closed candle prior to this movement lower. And then look at the delivery here. Boom, speed right down to that old imbalance. Then creates a consolidation. Is that surprising? No. What time of the day is it? It's New York lunch. So what is it doing? It's creating relative equal lows, and then it rallies. What is that going to entice traders to think? That's support. So any long holders, they're going to chase that. They're going to run it up into the breaker one more time, which is mean threshold, middle of this down close candle right here, the big beefy, longer bodied candle. Midpoint of that, and then shifts it lower, attacks the sell side, which is the classic run on New York lunch. It's a stop hunt. That's the macro for the lunch hour. There's a lot of people out there saying there's no lunch. Nobody's going to lunch, during lunchtime. Okay, these people don't know what they're talking about because the algorithm is going to reprice to those stops, and it's using time. What basis is it? It's the New York lunch hour. Look at time, 2:15, 1 o'clock. So in that 1 hour period between noon and 1 p.m. New York local time, we have now classic enticement for retail traders to see that as support. So that level right there is going to have a lot of sell side liquidity. And the market runs from the breaker down into that, hits it, and trades into the imbalance right here, which is institutional order flow entry drill as well. And this is also a fair value gap. This nice little retracement into that, and then delivers harshly right into that fair value gap. Moving into the afternoon, we can see that turn here. We rally up, consolidate, and then starts to rip higher, attacking what? The buy side here, then the old buy side liquidity pool, and then the weekly volume imbalance. So it's very quick run inside of the PM session, which is 2 o'clock to 4 p.m. New York local time. This is your PM session silver bullet. You get 2 chances here. 1, 2, rallies, and then the final market on close macro, which is the last, it's 315 to 345. In that window, you'll get another opportunity to set up a run for liquidity that has not been managed or engaged for that particular day, where the market fills the numbers, and it runs up, hits the buy side, hits the weekly volume imbalance as well, and just beautiful delivery. Beautiful delivery. All right, you can see again, here's that silver bullet, which is between 2 o'clock and 3 o'clock. So between 2 o'clock and 3, there's the silver bullet. One more little extra opportunity that's post 3 o'clock, but still using that setup here. So it's being reclaimed at fair value gap right there, and then it rallies up, trades back down, and look real close. You see this inefficiency here in that candle's high? How price runs through this shaded area. All of this area here gets repriced to. See that? That candle's low. Trade up into it here, a little bit higher, and then trades back down. It stops right there. Why is it stopping right there? Well, it only needs to go down to this fair value gap right there. And we've already traded up. Once this candle went down, the next candle opened, traded up here. So this is only inefficient. So it needs to only go to that level. Then it can rally and run to the buy side liquidity pools I mentioned last night. This is the power 3. This is what the daily candlestick looked like from 9:30 open. Small little movement lower, rallied up, creating the high of the day. I'll get into that high of the day in a second. And then closing here. So we have another classic buy day. Open, decline, Judas swing, rallies up, closes on the high, working that fair value gap. The 9:30 open was essentially near the low of that shaded fair value gap. Here is the opening range gap, which is the regular trading hours. You can see that difference between where we closed previous day and where we open at 9:30, that little shaded area. I hinted at something that we'll talk more about in the book, because these types of things are just too good. They're just too good for YouTube. There's too many yahoos out there trying to take my concepts, okay, make mentorships off of it. No credit to me. You know, I'm not gonna lay my best stuff out here. I will put it in print. That way you'll see it, and it's mine, and everybody will know that it came from me, because there's too many people still out there pretending that they found this on their own, or it's some dead guy that never have talked about it, okay, and I stole it or rebranded it from them, which is nonsense. But I talked about how you can take this imbalance and multiply that out and project it up, much like I taught with my central bank dealers range, and much like I taught with flout, and how I amplified what everybody that was aware of the Asian range for a long time. I supercharged that and taught you how to use it and make it better, okay, and I taught you in terms of standard deviations. But you can do that opening range gap the same way, and you can do projections higher, and then we have an overlap of negative 11 standard deviations, and price comes in at 4214.75, which is the basis of why I took my exit right at that low, which would be just a hair below this level here, and in 4214.75 looks like this, and we went just above it to trade into the 4215s. That was the high of the day. I'll counsel you to go look at Twitter. You can see my executions and such on the PM session for ES and NASDAQ. Market on close macro. All of this business in here was all discussed as it pertains to the PM session silver bullet and the final 15 minutes after 3 to 45 minutes after 3, that 30-minute window, that is a market on close macro. The algorithm generally will run for liquidity. Now, if the liquidity has been tapped, that means a higher time frame liquidity pool or target's been met, then it usually won't spool and start running. There's no need for it to do anything. Then if it's done that, the last 15 minutes of trading between 3:45 and 4 o'clock, you'll get some kind of little sputter move, which is, maybe it's good for 5 or 8, maybe 10 handles, maybe, but not terribly explosive. But like this, I told you last night what to expect. We were going to look for 4206. We were going to look for a 15-minute premium fair value gap, and we'd look for it to draw up into that weekly volume imbalances, that shaded area, and it delivered like gangbusters. So this is what we have here today, and hopefully And you can take this information and start to see that none of this is random. None of it is conjecture. It's a logic as to why price is moving the way it's behaving and what time it's expected to do so. It's a wonderful approach to trading where you don't have to rely on any kind of indicators. You're dressing your chart up. You're trying to stay organized. You're trying to anticipate, not react. You're trying to anticipate what price is likely to do next. It starts with a draw on liquidity. Draw on liquidity is just basically where's it going to go to next. Because if you don't have that information, if you have not determined that or have the skill set to be able to determine that consistently, you're not going to be profitable. I don't care what method you use. You have to try to see where price is needing to go to next. Who benefits the most? If smart money benefits by price going higher, you can look for retail traders to get punished. What would that look like? Relative equal lows. Retail sees that as what? That's a classic support to them, right? They take it down to take those stops. Why would those sell stops be advantageous to be liquidated? Because smart money will buy those sell stops. They'll be the counterparty to that sell stop being activated. They're buying that. So they're going long there where longs have placed orders to go long here based on this pseudo support. No. Price allows smart money to be the counterparty to those sell stops being engaged. So when those sell stops get tripped, there's a flood, a rush of selling orders in the marketplace, which is beautiful for smart money to accumulate that and be buying at a cheaper, low price. Then it rallies and it attacks what? The buy stops above here. Who would have buy stops above that? The people that were momentarily lucky, didn't take profits. They don't take partials. They don't take profits. They don't have to get out of the marketplace at the right time. Their stops is resting right above here in the form of a buy stop. Why would it be advantageous to trade there or above this level here or up into this weekly volume imbalance? Because smart money will look to distribute their longs there. So offset distribution occurs with smart money buying the sell stops, selling some above this high, selling some above here, and above here. And they liquidate that. And that liquidation of their longs above here, they're selling above here, which gives what? The retail traders the liquidity to be a buyer of when they're chasing price. When it breaks out here, who wants to buy that? Breakout artists. And the smart money selling their portion that they went long down here to there, which is why I'm teaching and teach my students to sell long positions partially above old highs and to cover short positions below old lows. That's what smart money does. It does not follow retail patterns. It does not look at moving averages. It does not look at breakout strategies. It doesn't do that, okay? They don't do that. The algorithm will set up scenarios where retail traders with that mindset will fall victim to it. And you don't want to be in that category. You don't want to be a classified neophyte forever in trading with retail logic, never coming to the understanding of what these markets are actually trying to do and how they book. So hopefully you found this one insightful. Until I talk to you next time, be safe.